Listen, most people don't lose money because they're unintelligent. They lose money because they're positioned for a world that doesn't exist anymore. Right now, we're in one of those periods where the headlines feel important, the opinions are loud, and the actual opportunity is quiet. That's always where the money is made. I'm not interested in what social media thinks is going to happen next quarter. I'm interested in what has to happen next because of debt, rates, and incentives, because incentives don't lie. And if you're holding the wrong mix of assets going into the next turn, you won't feel the mistake immediately. You'll see it later, when liquidity comes back, spreads compress, and the assets you ignored re-rate upward without you. Here's the misunderstanding. Most investors think opportunity is something you find. It isn't. Opportunity is something you prepare for. The biggest returns usually don't come from brilliance. They come from being properly positioned when the environment changes. And the environment always changes. People obsess over prediction, when the more profitable skill is structure. What do I mean by structure? I mean owning assets that can survive volatility, pay you while you wait, and give you optionality when the market offers discounts. If you think the goal is to be right, you'll chase stories. If you think the goal is to compound, you'll build a machine. That's what we're doing today. I've watched investors get wiped out in markets that looked safe. I've watched people overpay for growth because they couldn't tolerate patience. I've watched the same emotional pattern repeat: greed into euphoria, leverage into fragility, then panic into forced selling. And after that, every single time, assets that were ignored during the noise become the most obvious buys in hindsight. The reason is simple. Capital flows are cyclical, and the market is a discounting mechanism for liquidity. When liquidity is scarce, you get paid to own resilience. When liquidity returns, you get paid to own what was previously punished. So I don't try to win the argument. I try to be early, quietly, and right over a full cycle. Let me give you the framework I'm using, because without a framework, you're just reacting. Rule 1. Cash flow is not optional. If your portfolio depends on price appreciation to justify its existence, you're speculating. Cash flow gives you endurance. Endurance gives you control. Rule 2. Liquidity is a weapon. You want assets that can be sold when you choose, not when you're forced. The market doesn't punish bad ideas. It punishes bad timing and bad liquidity. Rule 3. Own what benefits from inevitabilities: demographics, fiscal math, energy demand, defense budgets, deglobalization, aging infrastructure. These are not opinions, they are structural pressures. Rule 4. Don't confuse risk with volatility. Volatility is noise. Risk is permanent impairment of capital. Your job is not to avoid volatility. Your job is to avoid ruin. Rule 5. The turn matters more than the level. Everyone argues about whether rates are high or low. I care about the direction of policy, the direction of inflation expectations, and the direction of financial conditions. Markets move on the change, not the absolute. Now, with that framework, here are the assets. Asset number 1, short-duration U.S. Treasuries and T-bills, the paid-to-wait anchor. Let's start with something that isn't exciting, because the best foundation usually isn't. In a world where cash yields something meaningful, you don't need to reach for risk just to feel productive. Short-duration treasuries do two things extremely well. First, they pay you to wait. Second, they preserve optionality. That optionality matters because the turn, the actual turn, doesn't announce itself politely. It shows up when spreads start tightening and the market stops rewarding caution. If you're sitting in short-duration instruments, you can redeploy quickly. You can ladder maturities. You can move into credit when spreads are wide. You can add equity exposure when valuations reset. This isn't timing the market. It's staying liquid enough to act when the market offers you price. A lot of investors don't understand this. They think cash is a position only when you're afraid. No, cash is a position when the risk premium is not paying you enough. If you're holding long-duration bonds purely because you think rates will fall, understand what you're doing. You're making a high-conviction macro bet with asymmetric downside if inflation reaccelerates. Short duration avoids that. It's not a prediction, it's a discipline. Asset number 2, quality dividend equities, cash flow businesses with pricing power. Now let's move to equities, but not the kind most people are emotionally attached to. When markets are fragile, I want businesses that can survive higher financing costs, maintain margins, and distribute cash. Dividend investing is not about income for retirees. It's about forcing discipline on management and aligning shareholder returns with real cash generation. What makes a dividend equity quality in this environment? It's not just yield, it's balance sheet strength. It's stable demand. It's pricing power. It's a history of not cutting payouts in stress. Because a high yield with weak coverage is not a dividend strategy. It's a distress signal. In periods like this, the market tends to overpay for stories and underpay for durability. And when the turn happens, the first thing institutions do is rotate into quality, because institutions need liquidity, scale, and defensibility. If you're holding companies that only work when capital is free, you are holding a fair weather portfolio, and markets don't always provide fair weather. Asset number 3, energy exposure. Not because it's trendy, because it's structural. Energy is one of the most persistently misunderstood sectors in public discourse. People discuss energy like it's a political preference. The market treats it like what it is, a necessity. Energy is embedded in everything: transportation, manufacturing, agriculture, chemicals, data centers, defense logistics. Even the most aggressive electrification narrative requires massive energy input upfront: mining, refining, shipping, building. And underinvestment in supply capacity tends to show up later as price pressure. That matters, because if inflation becomes stubborn, energy is one of the few places where cash flow can remain strong even when the rest of the economy slows. You don't need to believe in any particular scenario. You just need to respect the constraints. If supply growth is structurally limited and demand is steady or rising, the equilibrium price doesn't collapse permanently. It fluctuates, but the floor rises over time. Now, I'm not telling you to chase the most leveraged exploration company you can find. I'm talking about high-quality energy businesses, strong free cash flow, shareholder returns, conservative balance sheets, and real assets. Energy is not a trade. It's a hedge against policy error and underinvestment. Asset number 4, gold, not as a get-rich asset, as insurance against monetary and fiscal reality. Gold isn't magic. It doesn't produce cash flow. But it has one job: it sits outside the credibility of policymakers. And that becomes valuable when fiscal math gets uncomfortable. The US and most developed economies have a simple problem. Commitments are large, debt is large, and political incentives favor short-term relief. That doesn't mean hyperinflation. I'm not selling fear. It means the bias over time is toward currency debasement, slowly, persistently, because it's the path of least resistance. Gold's role is not to outperform every year. Gold's role is to keep your portfolio from being dependent on policy competence. It's an asset you hold because you understand that central banks can change rules, but they can't change arithmetic. And when markets become concerned about that arithmetic, gold tends to re-rate. Not because it's exciting, because it's neutral. Asset number 5, selective exposure to Bitcoin. Optional, sized correctly, treated as asymmetric. I treat Bitcoin differently than gold. Gold is insurance. Bitcoin is optionality. Bitcoin is not a cash flow asset. It's not a productive enterprise. It's a network asset with reflexive behavior, meaning flows matter. So here's the honest way to approach it. If you size it like a religion, you will eventually get punished. If you size it like an option, small enough that you can tolerate volatility, large enough that it matters if adoption expands, you're treating it like a rational allocator. Bitcoin tends to do well when liquidity expands, and when confidence in fiat credibility weakens at the margin. It tends to do poorly when liquidity tightens and speculative leverage unwinds. So if you own it because you understand liquidity cycles, not because you want to join a tribe. And if you don't own it, you're not behind. You're simply choosing not to allocate to that form of optionality. That's acceptable if you have other sources of convexity. But if your entire portfolio is long-duration growth and nothing else, you don't have convexity. You have fragility. Now, the objections. This is too conservative. The market always goes up. Over long periods, broad equities tend to rise. That doesn't mean your specific portfolio survives the path it takes to get there. Sequence matters. Drawdowns matter. If you're down 50%, you need 100% to get back to even. That's not theory, that's arithmetic. If rates fall, long-duration bonds and high-growth stocks will rip. Yes, they can. But you're assuming a clean disinflation narrative and a policy reversal without secondary effects. Sometimes rates fall because inflation is contained. Sometimes rates fall because something breaks. Those are different regimes and they reward different assets. I prefer positioning that doesn't require perfection. Gold is dead. Bitcoin is a bubble. Energy is cyclical. Maybe, in some years, but I'm not buying these to win a one-year performance contest. I'm building a structure that survives a cycle and benefits from the turn. The investor who needs every holding to be fashionable is the investor who will always buy late. I don't need agreement. I need results. Here's what happens next in plain terms. If financial conditions stay tight, weak balance sheets will get exposed. Margins compress. Defaults rise at the edges. Equity investors rediscover that profits matter. If financial conditions ease, capital will chase scarcity again, spreads will tighten, and risk assets will re-rate quickly, often before the public feels safe again. In both cases, the investor who wins is the one who already has liquidity to act, cash flow to endure, exposure to real assets, and optionality for upside. If you ignore this and stay concentrated in assets that require cheap money, you're not investing. You're renting performance from the liquidity cycle, and the rent always comes due. If you want continued clarity, without noise, without ideology, without emotional forecasting, subscribe. Not because you need more content, because in markets like this, the edge is staying rational when everyone else is reacting. And if you want the next piece of this framework, watch the next analysis, where I'll break down what I consider the most dangerous positions to hold going into the turn, and what institutional money typically sells first when volatility returns. That's where most portfolios get quietly destroyed. And I don't intend to let that happen to mine.